So what's a SAFE? SAFE, is an acronym for Simple Agreement for Future Equity, and it's simply a contract. It's not a security. You might view it, maybe Section 801 might call it a security, but technically it's not a security. It's basically a contract. And the idea is that the deal is done very simply because there are none of this panoply of agreements are not involved. I say to you as the investor in your company, hey, I'm going to put $100,000 in your company, and when you do your round, just like a convertible note, I'll convert into the Series A, and I can do it at a discount, et cetera, et cetera. They've come a long way since they were originally designed, and they currently have a lot of other features that kind of preferred rounds have. I think it's important to talk about where safes came from. Evelyn referred to this before. There was a woman by the name of Carolyn Levy who works for Y Combinator. She worked for Wilson Sonsini at the time. And there is a lending statute in the state of California that requires licensing for anybody who issues a debt instrument with a maturity date of longer than a year. So investors began to say, what are we going to do if we want a note that has a 13-month or 18-month or 24-month maturity? They looked at the licensing scheme, and it was extremely complex and costly to get licensed. So they had their lawyers dream up something else, and what they dreamed up was the SAFE, which has all the characters of a convertible note, or almost all of them, but is only a promise, right? You just have a contractual agreement to do that. So to allow the conversion. So, and right now there are various flavors of safes. There are safes with caps and discounts. There are safes without caps and discounts. There are safes with discounts and no cap, and there are safes with caps and no discount. A lot of the commentators suggested when safes came out that they would inexorably move from the West Coast to the East Coast, and by 2016, everybody was going to be doing safes. We have found that not to be true, particularly in the Atlanta region. And I wouldn't say that we're dinosaurs here in Atlanta. It really hasn't made it, that concept hasn't made it across the United States in any really effective way, because, as I said, they're solving a problem that doesn't exist here, right? We can do notes without running afoul of compliance issues. So we see them not very often, but it's a good idea to know what they obtain, because there are times when you might get a deal that you can't refuse to invest in, and it might be a safe. You should know the pitfalls, or at least the weaknesses of the safe, and primarily their downside protection is the biggest weakness. If nothing happens, what happens to your investment? And the answer is not a lot. You've done a couple of safes, Chris?
We haven't done a couple of safes. I've seen them come through in companies we were, looking to invest in. It's nothing that would have prevented us from investing. It was very favorable. Yeah, we haven't done them personally, but I've seen 3 companies come through that were, hey, we got a safe in the market, and that's what we're looking to raise under.
So I know that Mike is going to talk about pros and cons. I think one of the most important aspects of this is the fact that there's no maturity date on a safe, which, for an angel investor who's coming in and making that very early stage investment, when you're doing debt, you are looking for a time element to essentially push that company to be focusing on performance with the intent of either raising that capital or returning the investment at some point. And one of the major pushbacks that companies that structure the safes get from the angels is the fact that basically it could go on in perpetuity. because there is no structure within it to actually get you out. It's a negotiation at some point, which is interesting when you kind of read and listen to Carolyn Levy, who actually structured these. Because she comes out of Y Combinator again, her attitude is angel investing is pure risk capital. It's not about getting that money out if the thing falls over. This is about volume. And so when it's pure risk, you put the money in and you hope it's going to go big. And if you're making extensive volume investments, then it's not going to matter because one of them's going to win and it's going to pay for all the other money that you lost. So I just think that, again, it's just a completely different perspective on angel investing.
Yeah, I think that's a good point. There is, you see this in the arguments that are in the blogs and comments, that there is this view in the Valley that the folks who are investing in emerging companies have sort of a responsibility to allow that emerging company to have all the freedom that it can possibly have. I think in Atlanta we're less concerned about our Ilya Montanori responsibilities to emerging companies with our portfolios. There are a couple of interesting items also in safes that make them not so simple. For one thing, if there's a discount or a cap involved, they can't convert directly into the same security in the qualified financing that's issued in the qualified financing, because it changes the conversion rate of that security and the anti-dilution, and so the safe can't convert into that very same security if there's a discount or a cap involved. So what they do is they create what's called a shadow preferred that is the safe preferred. So you actually have now a capitalization that gets pretty complex at the time you do the conversion of the safe, because that's the only way it can work. The other thing is that in many safes now have a provision that says that if the company doesn't make it and there are proceeds from the dissolution of the company, the safe investors have a priority over the common. So there's no Series A involved, right? So there'd be no lick-pref, but what happens in a safe is the safe investors get their money out first. This is what I was talking about before as not being quite as good as convertible debt, because it's only a contractual obligation to pay those folks first. And if, for instance, there was convertible debt in that same company, I'd say the convertible debt holders win on who's going to get the assets in a dissolution. So let's talk about pros and cons of the safe for investors. One of the big issues is that they avoid debt on the company's balance sheet. They're less complex and easier to close in financing. You know, you'll see safes a lot in accelerators and incubators that do a lot of deals. You heard McClure say that if he had to pay for Series A preferred rates at Wilson Sonsini rates for the deals that he's done, he would have, you know, it would be a large expenditure because he does so many deals. Y Combinator over an 18-month period did 276 safes because they do most of their deals as safes. I did the computation. If they paid $50,000 in a Series A for those 276 deals, it would have cost them $13.8 million, right? So there is a reason for companies that do a high volume of deals to use that safe. Not because it works just as well for us as individual investors or even group investors, but because they have such a deal flow, they do that. Same thing you see safes in crowdfunding, because the crowdfunding sites are doing hundreds of deals. So that's kind of the way, that's kind of why we see a lot of safes in those areas. They are definitely less costly to complete. The cons are the limited downside protection. I talked about that. You have really no control, except now there are pro rata rights. There's a preemptive right in most safes now that you have a right to invest in future rounds, but you don't have any say in what's going on with the company as you do in a Series A. Lack of understanding in the Southeast generally is a good point. I mean, there's probably 5 lawyers in Atlanta that know what the hell a safe is, or how to negotiate one or put one into effect. And I had a deal. You, me, and Michael Horton were included in that group, Evelyn. I had a deal once where we started off, the company thought it was a great idea. Oh, these safes are nice, Mike, let's do a safe. So we did the term sheet, and the investor got a lawyer, and I tried to explain what a safe was. So we started talking about what happens in the preferred round and the shadow preferred, and he said, well, hell, if that's going to happen later on, why don't you just give me the preferred now? And it was difficult to talk him out of it. So what we ended up with was kind of a safe preferred round, which gave him a little bit of safe contractual rights and a whole lot of Series A preferred stuff. So after that, I didn't. When companies come up with this idea that we'd like to try that, I tell them that war story, and it's pretty persuasive. There is actually an issue that a safe could be could be considered deferred compensation under 409A. Most of you folks know what the effects of 409A. Your company has to get a valuation when it issues options, et cetera. There's an argument that safes are deferred compensation if some of the officers are involved in the investment, and you would have to go out and actually get a valuation. And then finally, there's no real protection. Investor protection in the qualified financing.